I've said it before, I'll say it again. The best way to make money in stocks is to not lose money in the first place. It sounds obvious, too obvious, like telling someone to look both ways before crossing the street. But the world is full of people who get hit by cars they never saw coming. I ran the Magellan Fund for 13 years. We beat the market by an average of more than double. But if you ask me what made the real difference, it wasn't the winners. It was avoiding the disasters. Let me give you an example. In the early 1980s, everyone was piling into oil stocks. Energy was the hot sector. Prices were soaring and analysts were predicting oil would hit $100 a barrel any day now. The crowd was convinced this was a can't-lose opportunity. I stayed away. Not because I was a genius, but because I understood one simple thing. When everybody knows something is a sure thing, it's usually a sure way to lose money. Oil prices collapsed, the hot stocks became cold corpses, and the people who thought they were geniuses learned an expensive lesson. The market doesn't reward you for following the crowd, it punishes you for it. That's the first lesson. If everyone's buying, you should be asking why. If everyone's selling, you should be asking if they're right. The herd is almost always wrong at the extremes. I learned this watching regular people make the same mistakes over and over. They'd buy at the top because they couldn't stand watching their neighbor get rich. Then they'd panic and sell at the bottom because they couldn't stand the pain. Buy high, sell low. It's the investor's version of slow-motion suicide. Know what you own. Here's something that shocked me throughout my entire career. Most people have no idea what they own. They'll spend weeks researching which dishwasher to buy, but they'll invest $10,000 in a company after reading one article. That's insane. I remember talking to investors who owned shares in companies they couldn't even name properly. They'd say things like, "Oh, I bought that tech stock everyone's talking about," or "My broker recommended this pharmaceutical company." When I'd ask them what the company actually did, how it made money, or what its competitive advantages were, they'd just stare at me blankly. You wouldn't buy a house without inspecting it first. You wouldn't buy a car without test driving it. But somehow people think it's perfectly fine to buy a piece of a business without understanding anything about it. That's not investing. That's gambling. And the house always wins when you gamble. The most dangerous words in investing are "I heard that." I heard that this company is developing a miracle drug. I heard that this retailer is about to explode. I heard that this technology is going to change everything. Hearing something is not research, it's gossip. And gossip is an expensive way to invest. When I bought a stock, I knew exactly what I was getting. I knew the company's business model, its profit margins, its debt levels, its competitive position, and its growth prospects. I didn't need to know everything, but I needed to know enough to make an intelligent decision. If I couldn't explain the company in simple terms to my teenager, I didn't buy it. That rule alone saved me from countless disasters. Because if you can't explain it simply, you don't understand it. And if you don't understand it, you shouldn't own it. The cocktail party theory. Let me tell you about my cocktail party theory. It's one of the most reliable indicators I've ever found, and it costs nothing. In the early stages of a bull market, when you tell people at a party that you're a fund manager, they quickly change the subject. They want to talk about anything except stocks. Dentists, lawyers, accountants, they all have horror stories about money they lost in the market, and they want nothing to do with it. That's when you should be buying. In the middle of a bull market, people start to get interested. They'll listen politely when you talk about stocks, and some of them might even mention a stock or two they've bought. That's fine. The market still has room to run. But in the late stages of a bull market, everything changes. Now everyone at the party wants to give you stock tips. The dentist is telling you about his portfolio. The accountant is bragging about the killing he made on tech stocks. The lawyer's secretary is day trading from her phone during her lunch break. When the person serving you drinks starts giving you hot stock picks, it's time to head for the exits. Because when everybody's in the market, when everybody's making money, when everybody thinks they're a genius, that's when the disaster is coming. I saw this play out in the late 1980s with biotech stocks. Every cocktail party, Every dinner, everyone had a biotech stock that was going to cure cancer or invent the next miracle drug. People who couldn't spell pharmaceutical were suddenly experts in drug development. The stocks went higher and higher, and then they crashed. Most of them lost 80% or 90% of their value. The miracle cures never materialized, and the investors who bought at the top got slaughtered. The cocktail party theory works because it measures psychology. And in the stock market, psychology is everything. When people are fearful, stocks are cheap. When people are greedy, stocks are expensive. It's that simple. So here's my advice. Pay attention at parties. If nobody wants to talk about stocks, start buying. If everybody wants to talk about stocks, start selling. It's the best free advice you'll ever get. Ignore the noise. The financial media is not your friend. I know that sounds harsh, but it's true. Turn on CNBC any day of the week, and what do you see? Panic, crisis, opportunity of a lifetime. Every single day is either the end of the world or the beginning of a new boom. It's exhausting, and it's designed to keep you watching, not to make you money. I used to joke that if you watched the financial news every day and acted on it, you'd be broke within a year. The problem is that the media needs stories, and stories need drama. A headline that says, "Market basically unchanged, nothing interesting happened," doesn't get clicks. But market plunges on fears of economic collapse gets everyone's attention. So they hype everything. Every small decline becomes a crisis. Every small rally becomes a boom. Every analyst's prediction becomes breaking news. And investors get whipsawed back and forth, buying and selling, based on headlines that will be forgotten by next week. Here's what I learned. The noise doesn't matter. The daily fluctuations don't matter. What some analysts said on TV this morning doesn't matter. What matters is the fundamental business performance of the companies you own. Is the company making money? Are revenues growing? Is the balance sheet strong? Are they gaining market share? Those are the questions that matter. Everything else is noise. I remember during October 1987, the market crashed 22% in a single day. The media was screaming about the end of capitalism, the new Great Depression, the death of the stock market. It was absolutely terrifying. But if you looked at the actual businesses, nothing had changed. Companies didn't suddenly become worthless overnight. Their customers didn't disappear. Their products didn't stop working. The panic was emotional, not rational. If you had ignored the noise and focused on the fundamentals, you would have realized that the crash was a buying opportunity, not a reason to panic. And if you'd bought good companies during that panic, you would have made a fortune over the next decade. So turn off the TV. Stop checking your portfolio every 5 minutes. Ignore the hot takes and the market predictions. Focus on the businesses you own and whether they're performing well. That's how you avoid losing money to noise. The biggest mistakes I made. People think that because Magellan was so successful, I must have been right all the time. That's nonsense. I made plenty of mistakes, big ones, expensive ones, the kind that still make me wince when I think about them. One of my worst mistakes was selling winners too early. I'd buy a stock, it would go up 40% or 50%, and I'd sell thinking I'd made a great profit. Then I'd watch that same stock go up another 500% over the next few years. I left enormous amounts of money on the table because I was too quick to take profits. The problem was I was thinking like a trader, not an investor. Traders look for quick gains. Investors hold great companies for years and let the compounding work. I learned eventually, but those early mistakes cost me millions in returns. Another mistake was averaging down on falling stocks without understanding why they were falling. I'd buy a stock at $50. It would drop to $40, and I'd think, great, now it's cheaper, I'll buy more. Then it would drop to $30, then $20, then it would go bankrupt. Averaging down works when the company's fundamentals are strong and the market is overreacting. It's suicide when the company's business is actually deteriorating. I learned to ask, why is this stock falling, before I bought more. If the answer was, the business is falling apart, then buying more was throwing good money after bad. I also made the mistake of falling in love with companies. I'd buy a stock, watch it perform well for a few years, and then refuse to sell even when the story changed. The business would start deteriorating, competitors would emerge, margins would shrink, but I'd hold on because I had an emotional attachment. That's not investing. That's stubbornness. And it cost me. The market doesn't care about your feelings. If a company's fundamentals deteriorate, you need to sell. Period. The lesson from all these mistakes? Even when you're successful, you're going to screw up. The key is to learn from those mistakes and make sure they don't sink your portfolio. Small mistakes are fine. Big catastrophic mistakes will ruin you. So focus on avoiding the disasters, not on being perfect. Debt is a killer. Here's something I learned that saved me countless times. Be very careful with companies that have too much debt. Debt is like gasoline. In good times, it accelerates growth and boosts returns. In bad times, it burns the entire company to the ground. I've watched great businesses with great products get destroyed because they borrowed too much. When times get tough, when sales decline, when the economy turns, companies with heavy debt loads can't survive. They spend all their cash servicing the debt instead of investing in the business. Then they can't make their debt payments. Then they go bankrupt. And shareholders get wiped out. I remember the retail sector in the 1990s and 2000s. Some retailers were conservatively financed with strong balance sheets. Others were leveraged to the eyeballs, often because of leveraged buyouts. When the economy slowed down or competition increased, guess which ones survived? The ones with manageable debt. The over-leveraged ones filed for bankruptcy, and their stock became worthless. I made it a rule to avoid companies with debt-to-equity ratios that made me uncomfortable. If a company needed to borrow heavily just to stay afloat, that was a red flag. If a company was using debt to fund acquisitions instead of generating cash from operations, that was a red flag. Now, some debt is fine. Most successful companies use some leverage, but there's a big difference between smart leverage and reckless leverage. Smart leverage is borrowing to fund profitable growth that generates returns higher than the cost of the debt. Reckless leverage is borrowing because you're desperate or because you want to goose short-term returns. The key question is this: if sales drop 20% next year, could this company still service its debt? If the answer is no, or even maybe, then you shouldn't own it, because eventually sales will drop. The economy will slow, competition will increase, and when that happens, the companies with too much debt won't survive. This is especially important for individual investors. Professional fund managers can diversify across hundreds of stocks. If one goes bankrupt, it's a small loss. But if you only own 10 stocks and one of them is overleveraged and goes to zero, that's a 10% hit to your portfolio. You can't afford that. So avoid debt-heavy companies. It's one of the simplest and most effective ways to avoid losing money. You don't need to swing at every pitch. Warren Buffett has this great line: in investing, you don't have to swing at every pitch. You can wait for the fat pitch right down the middle. That's brilliant, and it's one of the most important lessons I learned. Most investors feel like they have to be doing something all the time. Buying, selling, trading, watching. They can't stand to sit still. They see other people making money and they feel left out. They see a hot sector and they want in, so they swing at everything. Bad pitches, low pitches, pitches in the dirt, and they strike out over and over. I learned to be patient, to wait for opportunities where the odds were clearly in my favor, where I understood the business, where the valuation was reasonable, where the growth prospects were strong. If nothing looked attractive, I held cash. I didn't force it. The market always gives you opportunities if you're patient. Sometimes you have to wait months, sometimes years. But eventually, something good comes along, and when it does, you swing hard. I remember the savings and loan crisis in the early 1990s. The entire financial sector was in chaos. Banks were failing, real estate was collapsing, everyone was terrified. But if you did your homework, you could find well-managed banks with strong balance sheets, trading at absurdly low valuations. Those were fat pitches, and if you swung at them, you made a fortune over the next decade. But you had to be patient. You had to wait for the panic. You had to resist the urge to swing at mediocre opportunities just because you were bored. The investors who lost money were the ones who couldn't sit still. They jumped from one hot sector to another. They chased performance. They bought whatever was going up, and they got killed. So here's the lesson. You don't need to be invested all the time. You don't need to own every hot stock. You don't need to have an opinion on every sector. Wait for the opportunities where you have a real edge, where you understand something the market doesn't, and when those opportunities come, put real money to work. The rest of the time, sit on your hands. The simple math of losing money. Let me tell you something that should scare you. The math of losing money is brutal. If you lose 50% of your money, you need to make 100% just to get back to even. Think about that. Lose half, and you need to double what's left just to break even. That's a nightmare. And it's why avoiding losses is so much more important than chasing gains. If you lose 25%, you need to make 33% to recover. If you lose 33%, you need to make 50% to recover. If you lose 50%, you need to make 100% to recover. If you lose 75%, you need to make 300% to recover. The math gets worse and worse as the losses pile up. This is why I was always obsessed with not losing money. A 50% gain is great, but if you suffer a 50% loss, that gain just gets you back to zero. You've wasted years. Meanwhile, if you avoid the big losses, even modest gains compound into wealth over time. Let's say you make 15% a year for 10 years with no big losses. You'll more than quadruple your money. But if you make 25% a year for 5 years, then lose 50% in year 6, then make 25% a year for the next 4 years, you'll barely double your money. The loss destroys your compounding. This is why I was always more worried about the downside than the upside. If I could avoid the disasters, the 50% losses, the bankruptcies, the blow-ups, then over time my portfolio would compound nicely. I didn't need home runs, I just needed to avoid striking out. So ask yourself, are you focused on how much you could make or on how much you could lose? Because the investors who focus on not losing are the ones who end up wealthy. The investors who focus only on potential gains are the ones who end up broke. After running one of the most successful mutual funds in history, after beating the market year after year, after making my investors wealthy beyond their dreams, here's what I want you to know. The secret to not losing money isn't complicated. It's discipline. It's patience. It's common sense. Know what you own. Don't follow the crowd. Ignore the noise. Avoid debt-heavy companies. Wait for the fat pitch. And never, ever forget that the math of losing money is brutal. If you do those things, you won't be perfect. You'll still make mistakes, but you'll avoid the catastrophic losses that destroy most investors. And if you avoid the catastrophic losses, you'll get wealthy almost by accident. Because compounding takes care of the rest. I've said this 1,000 times. The real money in investing is not made in the buying or the selling. It's made in the waiting. And you can't wait if you've lost all your money on a stupid bet. So don't make stupid bets. Don't chase hot tips. Don't buy what you don't understand. Don't panic when the market drops. And for heaven's sake, don't let the crowd, the media, or your emotions make your investment decisions. You want to know how to never lose money? Stop trying to get rich quick. Stop looking for shortcuts. Stop thinking you're smarter than everyone else. Just be disciplined. Be patient. Be rational. That's it. That's the whole secret. And if that sounds too simple or too boring, then you're probably going to learn the expensive way. The market is a brutal teacher, and it will teach you that avoiding losses is worth more than any winning stock pick ever could be. Good luck.